Imagine waking up to find that one-third of your life savings has vanished overnight without a single withdrawal being made. While a sudden bank heist of that magnitude would dominate global headlines, a far more insidious thief operates in broad daylight, slowly siphoning away the value of your hard-earned money. Between the dawn of the year 2000 and today, the US dollar lost nearly half of its purchasing power, meaning the exact same currency buys only a fraction of what it once did. This is the reality of inflation, a persistent economic force that secretly steals wealth while most investors are looking the other way. To understand this silent, long-term erosion, we first need to clearly define our terms. Inflation is simply the rate at which the general level of prices for goods and services is rising, and subsequently, how purchasing power is falling. When economists measure this, they typically rely on the Consumer Price Index, a widely watched metric that tracks the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. But while the Consumer Price Index dictates the cost of milk and gasoline, its most profound impact is felt far away from the checkout counter, buried deep within your investment portfolio. The true danger lies in the illusion of nominal gains versus the stark reality of real returns. If your portfolio grows by 8% in a given year, you might feel a sense of financial victory. However, if inflation is running at 5% during that same period, your real return, which is the actual increase in your ability to buy things, is merely 3%. Deciphering this difference is the critical first step in protecting your financial future, as ignoring it means you might be moving backward even while your account balances appear to be climbing higher. For a stark demonstration of this phenomenon, we can look back to the 1970s stagflation era in the United States. During this turbulent decade, the economy suffered a brutal combination of stagnant economic growth, high unemployment, and double-digit inflation. According to historical data from the Federal Reserve, inflation peaked at a staggering 14.8% in March 1980. Investors who held their wealth in cash or long-term fixed-rate government bonds watched helplessly as their real wealth was decimated, trapped in assets that could not adjust to the rapidly changing economic reality. The fallout from that era fundamentally altered how financial institutions approach risk. The 1970s proved that traditional safe havens could become wealth traps if they lacked a mechanism to keep pace with a devaluing currency. Those early lessons in the destructive nature of unchecked price increases forced a radical rethinking of modern portfolio theory, pushing both institutional and individual investors to seek out assets that possessed intrinsic value or the ability to generate rising cash flows. This historical wake-up call brings us to the crucial concept of asset allocation, which is the strategy of dividing an investment portfolio among different asset categories, such as stocks, bonds, and cash. Proper asset allocation is your primary defense against economic volatility. By strategically placing capital into diverse buckets, you create a structural buffer that can absorb the shocks of a changing economic climate. When inflation strikes, a well-allocated portfolio shifts the burden of rising costs away from your principal and onto the assets specifically designed to weather the storm. Yet, despite knowing the historical risks, many investors still fall prey to what behavioral economists call the money illusion. As Nobel laureate Daniel Kahneman observed in his extensive research on human judgment, people tend to think of their wealth in nominal terms rather than real terms. We are biologically wired to see a $100 bill as exactly $100, regardless of whether that bill buys a week of groceries or merely a single dinner. Overcoming this cognitive bias is essential for anyone serious about offering protective strategies for their long-term prosperity. Let us examine the specific vulnerabilities in a standard financial setup, starting with the most common default, which is cash. While keeping a robust emergency fund in a high-yield savings account is a foundational rule of personal finance, hoarding excessive cash over decades is virtually guaranteed to destroy your wealth. Because cash generates little to no yield, it absorbs the full, unmitigated blow of currency devaluation. Every year that the inflation rate outpaces your savings rate, your stored labor is quietly confiscated by the broader economic system. Fixed-rate bonds present a similar, albeit slightly more complex, vulnerability. When you purchase a traditional bond, you are lending money in exchange for a fixed stream of interest payments over a set period. If inflation unexpectedly surges, the purchasing power of those fixed future payments plummets. The bond market ruthlessly penalizes these assets during inflationary spikes, driving down their resale value as new investors demand higher yields to compensate for the depreciating currency. But if cash is a leaking bucket and traditional bonds are vulnerable to rising prices, where exactly does smart capital go to hide? The answer lies in identifying assets that possess an inherent mechanism to absorb and reflect the rising cost of living. How do certain investments not just survive inflationary periods, but actually harness them to accelerate wealth creation? Equities, or stocks, represent one of the most powerful engines for preserving purchasing power over long-time horizons. When you own a share of a high-quality company, you own a slice of a living, breathing business that can adapt to economic conditions. If the cost of raw materials and labor goes up, companies with strong brand loyalty and market dominance simply pass those costs on to the consumer by raising their prices. This pricing power translates into higher nominal revenues and, ideally, higher nominal earnings, which in turn drives the stock price upward. This dynamic is supercharged by the mechanics of compound interest, which is the process where the returns on an investment begin earning returns themselves, creating exponential growth over time. When a company's earnings grow alongside inflation and those earnings are continually reinvested, the resulting compounding effect can outpace the silent tax of currency devaluation. The silent power of compounding still works its magic, provided the underlying asset is capable of growing faster than the rate at which money is losing its value. Real estate offers another classic textbook defense against a devaluing currency. Property values and rental income have historically moved in tandem with broader price increases. Because physical land and buildings are finite resources with intrinsic utility, their nominal price tags naturally inflate as fiat currency loses value. Furthermore, if a property is financed with a long-term fixed-rate mortgage, the investor actually benefits from inflation, as they are paying back their debt with dollars that are worth progressively less than the ones they originally borrowed. However, concentrating entirely in one asset class is a dangerous game, which leads us to the principle of diversification. Diversification is the practice of spreading your investments around so that your exposure to any one type of asset is limited, thereby reducing the overall risk of your portfolio. By holding a mix of equities, real estate, and other protective assets, you ensure that a localized downturn in the housing market or a specific corporate sector does not derail your entire financial plan. For those seeking direct, mathematically guaranteed protection against the consumer price index, governments issue specific financial instruments known as inflation-indexed securities. In the United States, Treasury inflation-protected securities, or TIPS, are the most prominent example. The principal value of these government bonds adjusts upward with inflation and downward with deflation. When the bond matures, you are paid either the adjusted principal or the original principal, whichever is greater, ensuring your baseline purchasing power remains fully intact. While these specialized securities offer a robust shield, they are not a magical panacea. Because the market knows TIPS provide guaranteed inflation protection, investors must pay a premium for that safety, which usually results in lower baseline yields compared to traditional treasury bonds. The strategic investor must weigh the cost of this insurance against their broader economic outlook, using inflation-indexed securities as a stabilizing anchor rather than the primary growth engine of their portfolio. Looking at the broader global economy, the drivers of inflation have grown increasingly complex in the modern era. We are no longer just dealing with simple demand-pull inflation, where too many dollars chase too few goods. Today, cost-push inflation, driven by fractured global supply chains, geopolitical conflicts, and energy transitions, plays a massive role in dictating the cost of living. According to recent data from the World Bank, global trade disruptions can trigger sudden, unpredictable spikes in commodity prices that ripple through the entire financial ecosystem. These global macroeconomic shocks directly impact corporate profit margins, forcing investors to become highly selective. Not all stocks offer equal protection. A company saddled with massive debt and an inability to raise prices will see its margins crushed by cost-push inflation. Conversely, businesses that control critical infrastructure, essential consumer staples, or proprietary technology often thrive as their customers have no choice but to absorb the higher costs. The post-pandemic economic environment provided a masterclass in these dynamics. As trillions of dollars in stimulus flooded the global economy simultaneously with historic supply chain bottlenecks, inflation roared back to life, hitting levels not seen in 4 decades. Investors who had grown complacent during the long stretch of low inflation in the 2010s were caught off guard. The market's reaction underscored investor sentiment, ruthlessly punishing speculative growth stocks that relied on cheap capital while rewarding established companies with robust, immediate cash flows. Navigating this environment requires a fundamental shift in how you evaluate your financial goals. You must stop asking how much money you will have in 20 years and start asking what your money will be able to buy in 20 years. This subtle but profound change in perspective forces you to prioritize real returns over nominal gains, transforming you from a passive saver into an active protector of your purchasing power. As we look toward the horizon, the question remains whether the coming decade will resemble the high inflation environment of the 1970s, or if technological deflation and demographic shifts will pull prices back down. While no one possesses a crystal ball, the structural forces of deglobalization and massive sovereign debt burdens suggest that inflationary pressures may remain a persistent feature of the financial landscape. Therefore, your investment strategy cannot be a static document. It must be a living framework, capable of adjusting to shifting monetary policies and evolving market conditions. Regularly stress testing your portfolio against different inflationary scenarios ensures that your wealth remains resilient, regardless of what the Federal Reserve or global commodity markets dictate. Financial literacy is the ultimate hedge against economic uncertainty. Understanding the mechanics of how money loses value empowers you to make proactive, calculated decisions rather than reacting out of fear when headlines scream about rising prices. As legendary investor Warren Buffett has frequently pointed out, the best protection against inflation is your own earning power and your ability to allocate capital efficiently. The silent tax of inflation will never completely disappear, but it does not have to be the thief that ruins your financial future. By deciphering its mechanisms, embracing assets with pricing power, and utilizing specialized tools like inflation-indexed securities, you can build a fortress around your wealth. Those early lessons in diversification still hold true, providing the blueprint for a portfolio that not only survives economic turbulence, but thrives within it. Ultimately, building lasting prosperity is about recognizing that money itself is just a measuring stick, and its length is constantly changing. Your true goal is the accumulation and preservation of purchasing power. By keeping your focus on real returns and deploying protective strategies with analytical rigor, you can navigate the complexities of the modern market with clarity, confidence, and enduring financial strength.